Well, 6 o'clock. Good evening, everyone, and welcome to our latest installment of Michigan's first virtual series on credit awareness. My name is Matt Haloris. I'm the Lending Center Manager here for the Credit Union, and we're really excited to have all of you on tonight for this event. For those of you that have been members with us for a while, hopefully you've had the opportunity to attend one of our in-person credit awareness seminars. We typically hold those once a year, and in those events, we span about 2 or 3 hours and take a deep dive into what makes up a credit score and how to effectively manage your credit to ensure that when you need to borrow money, you have the best chance to get the best rate you can. This installment of our quarterly webinar series on credit awareness and management will provide you with expert guidance on managing your credit score and its impact on your finances. All important stuff. As always, we're really fortunate to have with us today the person that I consider to be one of the preeminent experts in credit in the entire industry, our AVP of Lending Operations for the Credit Union, Mr. Noel. Brock has been with the team for about 15 years and has worked in the financial services industry for 20 years, educating not only our team in that time, but many of our team members on how to best manage through credit and also some financial challenges to ensure that the cost of borrowing remains affordable, not only in the short term, but in the long term too. So before we get started, I got some quick items to note, a few housekeeping things. The chat feature within the presentations platform will be your opportunity to present questions to us. No real-time audible questions will be taken. We have everyone's mics muted and their videos disabled. Please direct messages to myself or Jamie Baker, and we will address them at the end. The information presented today should last about 40 minutes, and we'll take some time, like I said, at the end to review the questions and answer them. We'll end no later than 1 hour. So with all that, and without further ado, it's my pleasure to hand the presentation over to Brock to begin. Thank you, Brock.
Thanks, Matt. Appreciate the intro there. And welcome everybody to our latest installment of our virtual credit seminar. As Matt stated, we try to do these at least 4 times a year. I just want to say at the beginning, if you've gone through one of these before, or if you've gone through all of these before, feel free to stay on. We're going to talk about a lot of the same things that we usually talk about, but I found over the years that talking about this a lot and at least doing it a couple times a year keeps it fresh in your mind. So some of the things you maybe picked up last time that you remembered, we'll go over those again, but maybe some of the stuff that slipped through the cracks, you can pick up on again, and that way you can incorporate this into your own lives. And also, I think it's important to know that our lending opportunities change over time, and our members' lending needs change over time. When you went through a credit seminar before, maybe your score was high and now it's low, or vice versa. Maybe it was low before and you took our advice and now it's high now. And so your circumstances have changed. Some of this information might mean something different to you than it did last time. So if some of this stuff sounds familiar, try to stick with us and maybe you'll learn a few new things. And also, like Matt said, at the end of the presentation, we're going to open it up for questions. So if you have questions, feel free to chat those away with Matt and Jamie, and we'll bring them up at the end and go over those. And I know as we go along, things will pop up and you'll think of things. Make sure to jot those down in the chat and we'll answer those at the end. One thing that we want to talk about today is, why do credit scores matter and how can you use your credit score as a financial asset? The last couple of years, let's face it, have been fairly difficult for most Americans. A lot of us are living paycheck to paycheck, and our dollar isn't getting us as much as it used to, is it? I know that when I go to the grocery store, I have 2 kids. My son now is 13 years old and he's eating like a horse. So when I go to the grocery store, my grocery bill is way more than it used to be. So I try to strategize when I go to the grocery store and say, okay, what can I get that maybe costs a little bit less money? Do I need to start buying the value brand at Meijer as opposed to getting the name brand? And a lot of us think that way. When we're talking dollars and cents, it's easy because this is stuff that we live every day. But one thing that we like to do at Michigan First is educate our members that your credit score can do the same thing for you. A lot of our members don't realize when they go to the car dealership that they can get different payments for that same car that they're getting, right? A lot of us just think that we go into the dealership and we get a payment for that car in particular, and That's our only option. And we're here to talk about that today to let you know that no, that's not your only option. If we can improve your credit score, you're going to pay a lot less money for some of the things that you need to borrow money for, whether it be a new car, whether it be a house, especially a house. Your credit score can make a huge difference in your house payment. Or whether you need to take a personal loan out. Sometimes with credit cards, you get a better interest rate. So it goes on and on and on. And we're going to talk about some of those examples of how you can use that credit score to your advantage. That way, if you have a higher credit score, you're going to have more dollars and cents in your wallets or purses to go out and buy for things that you need in the real world. So let's get into it. Why do credit scores matter? The first thing we're going to do right out of the gate is go over an example. And what I would like to do is put you in a real world scenario where you are going out to buy a car. A car for most of us is one of the biggest purchases that we're going to make in our lives, and one that we're going to do the most times in our lives for a big ticket item. A lot of times we might buy a house or 2 or 3 houses, but a lot of times it's not more than that. And some of us may not ever be homeowners, and that's fine. So a car is a great example that most of us are going to go through in our lives and have to purchase one. So in this example, we're going to use a relatively small number in today's standards, a $25,000 car. You know, that doesn't get you as much as it used to. For anybody who's bought a car in the last few years, you know this firsthand. So what we'd like to do is, let's take a look at an example of what someone with a high credit score would pay for a $25,000 score, or $25,000 car, excuse me, versus what somebody with a lower credit score would pay for the same exact car. And for this example, we're going to use 60-month term. That's 5 years. That's pretty common in the industry. And with our A+ borrower who's got a high credit score, we're going to show them at a 722 credit score, whereas our E tier member, which has a lower credit score at 542. Okay, so there's a pretty wide gap there in the credit score. Our A+ member, we're going to show at a 3.24% interest rate. That E member is going to get a 19.49% interest rate. Now, rates have changed a little bit. They fluctuate up and down. They're a little bit higher than these examples right now in today's market, but the gap in those rates is about the same. Right now, an A+ member can get about 5 or 6% on a car, whereas an E tier member, wow, you might be getting into the 20%, or if you finance with a company like Credit Acceptance or Santander, you might be close to 30%. So the gap is very large in the interest rates, and that makes a big difference in how much you're going to pay for that car. And this is all dictated, remember, by your credit score. So someone who has a 722 credit score in this example is going to get a 3.24% interest rate. So for that $25,000 car, they're going to pay $451.90 per month. That's a pretty affordable payment for a $25,000 car. So the total amount that they're going to pay for that car, when you factor in the interest, is going to be $27,113. Okay, so really, you're only paying about $2,700 in interest there. That's not very much over the life of that car. That's really good if you can get that. However, and this is an extreme example, let's look at what that E tier member is going to pay for that exact same car. At the 19.49% interest rate, their payment's going to be over $655. That's a huge difference between those two payments. And here's the kicker. For that loan, $25,000, over the life of that loan at the higher interest rate, they're going to end up paying over $39,000 for that car. Just think about that. Look at the difference in the interest that you pay. That's huge. So let's look at the numbers a little bit deeper. Again, the payment difference is $451 versus $655. That's $203 a month. If I could tell you right now, Mr. or Mrs. Member, you're going to have an extra $203 in your pocket every month, I think all of us would take that, especially in today's market. That's a lot of money. $203. That could almost get you another car. And that's $203 every month that you would save over the next 5 years for that loan example. Let's look at that interest, right? For a $25,000 car, you're going to end up paying $27,000 with an A+ tier. On that E tier, conversely, you're going to pay over $39,000. That's over $12,000 more just because you had a lower credit score. $12,000. That is a lot of money over 5 years. If I told all of us, hey, over the next 5 years, you're going to get an extra $12,000, all of us would sign up for that deal. This is why this is so powerful. And this is why your credit score can work to your advantage, or maybe it's working towards your disadvantage. Maybe you're paying too much money than you need to be. And that's why at Michigan First, we try to educate our members so that you're not paying more than you need to, right? If you invested $12,000 in a money market account or a CD or an IRA, you could make a lot of money off that in the next 5 years. So again, this is money that can go back into your pocket that you could reinvest into whatever you want. So let's move forward. But that's a great example, and it shows you how much a credit score matters in the real world. So some of you may be thinking, okay, that's nice, Brock. My credit score isn't good right now, so what can I do about it? I have to go buy a car next week. What can I do about it? There are some things that you can do to increase your credit score. Some of them take longer than others. Some of it can be a quick fix. And I know in America, we sure like a quick fix. So let's talk about what the quickest way is to increase your credit score. And it has everything to do with something that's called your credit capacity. It's the fastest way to get your score higher. So what is credit capacity? And what affects credit capacity? So there is several things that dictate what your credit score is. There's different factors that weigh in your credit score. The biggest one, and one that we're not going to talk about tonight, is how well you pay your loans. I think everybody knows that one. If you pay your bills on time, you should have a better credit score. But something that affects your score almost as much as how well you pay is credit capacity. And the loans that affect credit capacity are your credit cards and any lines of credit that you may have, not including home equity lines of credit. So just regular lines of credit, whether you have a credit card or you have that personal line of credit. Back in the day with the credit union, we used to call that our signature loan. But it's those loans that you can use and pay them down and reuse them again. They revolve, and that's why it's called revolving debt. So credit cards are the best example. That's the one that most of our members have that they use that can affect their credit capacity. So what is credit capacity? It is the ratio of combined revolving credit balances to combined credit limits. Now, that doesn't really make a whole lot of sense to me, so I like to break it down a little bit easier. In other words, what percentage of your revolving credit is available but not used? All of our credit cards have a credit limit that we can go out and spend. Okay, so let's say you have a credit card and your limit's $10,000. You could legitimately walk out the door and go spend $10,000 right now on that credit card. So you have that limit, $10,000. How much of that limit are you using? That's your credit capacity. So if you're using it all, you don't have any credit capacity, and that hurts your score. And it can hurt your score significantly. So it's always good to keep those balances low. This is really important, and we want to take a second to let this digest because this is how powerful credit capacity is. For every percentage point you gain in capacity, you gain about 1 point on your credit score. So think about that. If you have that $10,000 credit card and you're maxed out on it, your balance is all the $10,000, your capacity is 0 right now. So you're technically losing about 100 points off of your score. So if you paid that off in one fell swoop, I know a lot of us can't do that, but let's say you came into some money and you paid that credit card off, all $10,000, and your balance was now 0, and your limit was still at 10,000. Now you have 100% capacity. All of it's available to you. Your score can go up about 100 points. Now, many of us have several credit cards, so it's not as easy as just one credit card. But the thing that the credit bureaus are going to do, TransUnion, Equifax, and Experian, those are the credit bureaus. What they're going to do is add up all of your credit limits and get one number. So if you have 10 credit cards, they're going to add up all the limits from your credit cards into one number. And they're also going to add up all of your balances into one number. And they're going to see what is the ratio that you're using. So it's still, whether you have one credit card or 10, it's still what's your limits on all those combined and how much of them are you using, and they're going to take a percentage of that. So if you're using half of your balances, you're at 50% capacity. So you're losing about 50 points off of your score if you're halfway maxed out on your credit cards. Again, every point you gain, percentage point you gain of capacity could get you about a point on your score. And that could be instant. So if you paid off all your credit cards, your score could go up the next month significantly. So how do we calculate credit capacity? I know we've talked about it a little bit. Here's that example that I gave earlier. You have a $10,000 credit card, and right now you've charged $4,000 on it. So how do we calculate it? Well, the nice thing is for everybody to know, as an aside, we're going to do some math here. But if you get a copy of your credit report, the credit bureaus do this for you already, so you don't have to calculate it. There's a number on your credit report that will show you what your capacity is. So if you have a copy of it and you can't find it, just come on in. We can show you. If you want to get a copy of your credit report, you can certainly come on in and we can pull one for you and show you what your capacity is. So for this example, we have a balance of $4,000 on our $10,000 credit card. So what we would do is we would take our limit, $10,000, and subtract our balance, $4,000. Then we get $6,000. That's how much we still have left to spend, $6,000 if we wanted to. And we just take what's left to spend, the $6,000, and divide it back by our credit limit. And that gets us, I know this is easy math, it's the best kind I like to do, 60%. So we have 60% capacity. All right, so how do we gain credit capacity? That's one of the biggest questions that I get is, how do we get capacity? It's nice that we're talking about it, and it's nice that I'm trying to keep my credit limits low, but sometimes life throws a monkey wrench at us, right? And we have to spend money that maybe we didn't think we needed to. So how do we gain credit capacity? The easiest way to do it is to pay down your revolving debt. Now, I know that that's easier said than done. Not all of us have money just laying around that we can pay our credit card balances. If we did, we probably wouldn't have credit card balances in the first place, right? But how can we pay it down? There are other ways than just having money in your savings account to pay down your credit cards. And we'll go over those in a moment. Another thing that you can do, which a lot of members don't think about, is to raise your limits on your credit cards. So in that example that we just went over, you have a $10,000 credit card, and let's say you're maxed out on it. You're using all 10,000. Well, what you can do is call your credit card company and say, hey, I would like to get an increase on my limit. And if they grant that to you, let's say they say, sure, we're going to take your limit up to $20,000. Well, now, instead of having a $10,000 balance on a $10,000 limit, you have a $10,000 balance on a $20,000 limit. You've just taken your capacity from 0 to 50 because now you're only using half of it. So that's an easy way to get some credit capacity. So you can pay down your limits, you can raise your revolving limits, or you can do a combination of the two. Why not? Pay down as much as you can and see if you can get an increase on some of your others. That will increase your credit capacity. Another thing you can do is to make sure that all of your home equity lines of credits are reporting on your credit bureaus as mortgages. There are some companies out there that are notorious for showing your home equity lines of credit as just regular revolving lines of credit instead of mortgages. And a lot of us take home equity lines of credit out to use them, especially if we have house repairs that we need to do. So if we're maxed out or using our home equity lines, we don't want that to mess with our credit capacity. So it's real easy. You get a copy of your credit report and just make sure that they're showing as mortgages and not as revolving debt. We don't want those lumped in with your credit cards. Another thing you can do is make sure that your credit cards are reporting the credit limits. There are some credit card companies, American Express is one that comes to mind right off the top of the head, that don't show or don't report your credit limits to the credit bureaus. So you could have an American Express card with a $50,000 credit limit. And if you've charged up $20,000, if they don't show that limit to the credit bureaus, it's going to look like you're $20,000 over your limit because it doesn't show a limit. So if you're finding yourself in that situation, you might want to give them a call and say, I really need you to report my credit limit here because you guys are killing my credit score. And if they refuse to do so, maybe it's time to do business with someone else. So we would love to have your business. Our rewards card, just as good as those American Express cards, and it's local. And we offer rewards for doing shopping in Michigan too. So take a look into that if you need to. One other thing that I want to talk about that you can do is a debt consolidation loan. A debt consolidation loan is where you take an installment loan, which is a loan where you have a term on it. You take out a lump of money, you pay it down, and then it's over with. If you take out an installment loan, a debt consolidation loan, and pay off your credit cards, it's going to show that your credit cards are at a zero balance and your capacity is totally freed up. Even if you have a new loan on your credit report for the same amount of money, that installment loan doesn't affect your capacity. So if you get a personal loan for $10,000 to pay off a $10,000 credit card, all of a sudden you don't have any credit card debt anymore. Your capacity goes up to 100%, increases your credit score. You have an installment loan now for $10,000. That installment loan doesn't affect your credit capacity at all. So that's why consolidation loans can be a very powerful way to get this increased as well. So let's say you run into some rough times. All of us do in our lives, no matter what. No matter how good you have it sometimes, you're always going to go into those valleys sometimes where you're having a hard time. Life throws you a curveball. I always say this, bad stuff happens to good people every day. It's just an unfortunate part of life. If you find yourself in that situation, your credit score might go down or it might take a hit. So what do you do in tough times? Well, there's some tips that you can do, and there's some things you should try to avoid. Number one, keep in close contact with your creditors. A lot of creditors will try to help you out in times of trouble. At Michigan First, we certainly do that. Keep your arranged promises. So if you say, hey, I can't pay you this month, I'm going to pay you next month, make sure you try to keep that promise. Try to stay in that open communication and live up to your end of the bargain, especially if your financial institution is working with you. You might want to consider some nonprofit credit counseling. Before you do this, I would say come in and talk to us first. We have some companies that we do business with in the area that are very reputable credit counseling services, and they have no affiliation with us, but we certainly try to place our members in the best position possible. So come in and talk to us if you need to go down that route, because there are a ton of bad credit counseling services out there. Debt relief companies that are going to do you wrong. That are going to totally tank your credit score. So please come in and talk to us before you get involved in any of those. But sometimes if you get with those reputable companies, they can help you out tremendously. And see if moving your business over to Michigan First can save you money. There have been so many times over my career here at Michigan First where a member has come in and talked to me and they think all hope is lost. They don't think that there's any way out of their situation. They want to file bankruptcy. They want to go to a credit counseling service because they've thrown their hands up and said, I can't do this anymore. And we have creative ways that we can help over on our end too. I've helped so many members over the years that have thought that hope was lost. We brought them back up, got that score back up where they needed to go. So always come in and talk to us. We might be able to save you some money. We can certainly give you some good advice, and we can come up with a game plan. Some game plans take longer than others, but that's okay. It can be a quick fix. It can be a long fix. Either way, if you're not going to know until you get that advice. I always tell this to our members too. In life, we all have that mechanic that we go to. We all have that electrician that we go to. I have a bee guy that I just hired to come and spray my house, the perimeter of my house for bees. I've been using them for 5 years. We all have a habit of using trusted people in our lives to take care of things like that. Electrician, plumbing, mechanic, you name it. But a lot of us don't have a finance person. A lot of us don't think we can afford a finance person. But if you're a member of the credit union, you can come in and talk to us at any time. We can be your finance person. We can be the one that gives you the advice, especially when it comes to loans, lending, investing your money. Let us be that person in your life that gives you the advice. Whether you come in and talk to us every month, or maybe it's just once a year just to check in. You never know what the latest and greatest is in our industry, but we do. We're the experts, so come talk to us. Some things that you should try to avoid if you find yourself in a precarious position with your credit or your finances. don't make arrangements that you can't keep. Be realistic with yourself and don't make any arrangements that you can't live up to. This is a big one and one that's really hard to do. Don't spend more than you have. It's very tempting if you have those credit cards out there and limits that you can use to go use them. If at all possible, try not to use any more than you can't pay back at the end of the month. Or if you do end up in that situation, come talk to us. Maybe we can give you a consolidation loan to get that thing paid off. Because if you charge your credit cards up, let me tell you, and you only pay your minimum balances or your minimum payments, you are never going to pay that balance off in your lifetime. If you open up your statements and read those, it'll tell you exactly that. It might be hard to decipher, but there are legally forced on your credit card applications to tell you, if you make your minimum payment, how long it's going to take you. And that date that's on your statement is not going to be in our lifetimes, let me tell you. So don't spend more than you have unless an emergency happens. Then if that comes up, come see us. Maybe we can do a consolidation loan. And don't try to borrow your way out of trouble. This is a mistake that I see a lot of our members make. They try to borrow themselves out of a situation, and it usually doesn't end up very well. You kind of just go in an endless cycle, and you keep borrowing over and over and over again, and then you just put yourself in a worse position. And in the end, it hurts, and you wish, man, I wish I would have taken care of this a little while ago in a different way. So if you find yourself in a situation where you think, I have to borrow my way out of this, come talk to us first, and we can give you some good advice. And as I said before, I jumped the gun. Don't get involved with credit repair companies if you can try not to. They are in it for themselves. They're not in it for you, and you're going to end up hurting your credit score so much that it's going to take you a lot longer to get out of that hole. So how can we reestablish our credit if it's gone by the wayside? Always maintain a good relationship with your financial institution. This is big. I've harped on it a lot so far. Come in and talk to us. We should be there. We should be your go-to person to help you with your finances. Clean up what you can. A lot of times, if you find yourself in a situation where your credit score is lower, it might not be a quick fix to get out of there, but you can dink and dunk at it and make it better than it is. So be patient. You know, it's not going to always happen at once. Sometimes it can, but most times it can't. You need to start off small if possible. You can do a credit builder loan. We have a couple products here that if you find yourself in a situation where you don't have any credit, or if you've fallen on hard times and you don't have good credit, we have some credit repair loans that can help you along the way. You're always going to pay more until your credit score improves. If you don't leave out of here with anything, leave out of here with that statement. You will always pay more until your credit score improves. Whether you take out a personal loan, a car loan, or a mortgage, and the larger purchases are more, you know, the savings can be more, you're always going to pay more. You got to get that credit score up. And I say this all the time too to our members. It's never too late to repair your credit. I've never seen someone so far gone that they can't come back. It might take longer, but even if you filed bankruptcy recently, even if you're in a bankruptcy right now, there's always a way out of that and always a way to build your credit score back up. And you need to keep your resolve and make sure that you don't repeat any financial errors. We've all made mistakes before. I certainly know I have made mistakes in the past when it comes to my credit. The important thing is to learn from those and find people that you can trust to help you along the way. And in our case, we hope you come and talk to us because we can certainly help you out. All right. So that is the end here. And I'm glad that you sat with us. We did it for about 30 minutes here. I know it's a very beautiful night. I didn't want to keep you too long. Maybe you can get out there and enjoy the weather. Matt and Jamie, I don't think I saw anything in the chat. Did we have any questions?
No, Brock, I don't see any so far.
Okay. Oh, someone has Raven has a question. Go ahead, Raven. While Raven's typing her question, I wanted to shout out Trinetta Redmond, who's on this. I saw her as a participant. Trinetta used to work for us and worked with me for a number of years. So I wanted to say hi to Trinetta. All right, Raven, go ahead with your question. Type it out if you can. All right, so Raven said that she's asked for an increase in her credit card limit and was told she had to wait till around November. So one thing that I know that our underwriters try to do when a member of ours applies for a loan, whether it's an increase on a credit card, a personal loan, we try to, if we can't help at that time, give a roadmap of maybe when we can help. So there are certain times, and I don't know your specific situation, Raven. We can certainly contact you afterwards or get with you. And we try to tell our members, hey, right now we're not going to be able to help you, but here is a good way to get approved in the future. Wait 4, 5, 6 months, keep paying your bills on time. Don't take out any new loans, and then let's attack that around November and try to get you approved at that time. So, so not sure if that answers your question, but there are some times that you have to wait. Now, you said your credit's good and your payments are on time. That's great. That's not the only thing, again, that goes into your credit score. Sometimes, especially if you've taken out debt recently, we want to see that spending slow down before we're able to do anything. And a lot of this isn't directly from the credit union. We have people that we answer to for our loans. And so what the people that we answer to for our loans, our auditors, we want to make sure that we're doing right by them, because we don't want to run into a situation that they think we're putting our members in a worse position by giving them more debt. So sometimes we have to say no now, but that's not no forever.
Okay, Brock, one other question here that came up. When doing a consolidation loan, is there still interest involved in a consolidation loan?
Say that again, Matt, you broke up.
When you're doing a consolidation loan, a debt consolidation loan, is there still interest involved when taking out a loan like that?
Yes, there is interest with an installment loan. Just like that car loan example that we talked about, there is going to be interest. A lot of times with debt consolidation loans, see, that car loan that we looked at was a $25,000 loan, so it's a pretty big loan. If you take out a $5,000 unsecured loan or somewhere around there as a debt consolidation, you are going to pay interest on it. It won't be as much, but you are going to pay interest on it. Yes.
Thank you.
I see a good question in here, Matt. It says, I run a business and my credit cards are instrumental in my business. It also affects my credit score because of usage. What can I do? Kenya, to answer your question, and a lot of business owners do this, especially if they have a business credit card. One thing you can do is try to pay those off as quickly as you can. And also, whatever credit cards you're using, call those companies and find out when they report to the credit bureaus, because they report to the credit bureaus once a month. If you can get those credit cards paid off before that date, it shouldn't report your balance. So you want to find out when they report to the credit bureaus and make sure that they're paid off before that date. That way, if we pulled your credit, we might not see it. We won't see a balance on there. All right, I see another question from Catherine that says, how do I feel about soft inquiries? Soft inquiries are fine. Soft inquiries on your credit report aren't going to affect your credit score. Now, some of you ask, what are soft inquiries? There's a difference between a hard hit on your credit pull and a soft hit on your credit pull. A hard hit is when you call and apply for a loan or go in and apply for a loan. Like if you go to the car dealership and try to get a car, that's going to be a hard pull on your credit report. Those can affect your credit score by a few points. A soft credit pull doesn't affect your credit score. So what are some examples of soft credit pulls? A lot of employers these days will pull your credit. That's not going to affect your credit score. Doctor's offices might pull your credit. A soft pull. That's not going to affect your credit score. So don't worry about soft credit pulls. They don't affect your credit score.
Got another one, Brock. When you're asking for a credit increase, will that impact your credit score?
If it's a hard pull, yes. Yep. So if you call and you call your credit card company, if you call Michigan First and you try to get an increase on your credit card, yes, that is going to be a hard pull on your credit and it could lower your score. But again, that's only a few points. If you get that increase, just think about the number of points you're going to gain by having that higher credit limit. And Raven, I do see your messages. I'd be happy to talk to you offline. Why don't you put your phone number here in the chat, or don't, you know what? Don't put it in the chat. I'm sorry. I will go ahead and get with you offline, and we can figure that out together. A free credit pull does not impact your credit score. You are allowed once a year to go to the credit bureaus and get a copy of your credit report. And they will send that to you, and that's free. All right. Well, I think that's about it. So I appreciate you all for taking the time tonight. And if that's it, Matt and Jamie, if you don't have anything else, I think that we'll be able to end that right now. And you guys enjoy your evening. If you have any other questions, if you think of anything afterwards, call us, come in and talk to us, and we'll be happy to answer those questions for you. Have a good night, everybody.